Adobe is one of the most interesting companies in the world right now. The price is the lowest it's been in years, yet revenues are growing, cash flow is growing, profits are growing. But as part of the SaaS apocalypse, the world is terrified that SaaS is going to be eaten by AI. And it caught my attention because the more I look into it, the more interesting I think the discussion gets. So I've actually spent basically a month researching Adobe, and I've put together a 6-part breakdown to understand the entire business. So this is going to be the first series on the channel where I do a really thorough deep dive to truly try to understand what a business is, using my knowledge and experience as a CPA and senior financial analyst. So in this video, we're going to start with just a really high-level understanding of what the business model is, the products that are offered, who the customers are, and then in subsequent videos, we'll go a lot deeper and we'll look at the fundamentals on the financial statements. We'll try to understand the moat and how Adobe competes. We'll look at the threats and opportunities that AI provides. We'll really get to know who the management team is, because that is so important when you're trying to understand a company. Ultimately, it's the people that make it tick. And then finally, we'll do a quick look at the current valuation. A couple notes before we get started. First, this is not financial advice whatsoever. I'm simply trying to understand the company as a business because I think it's interesting, and I'm sharing those learnings with you, as well as teaching how to understand a business and the frameworks to think through it with. We're also going to be mostly looking at fiscal 25 data. At the time of recording, Q1 of fiscal 26 has been released, but I want to look at the full year of FY25 as our baseline, because it represents a full operating cycle and has a full year's worth of information baked into it. And then later on, we'll pull in data from Q1 where we need to get up-to-date context. Now, I also do own a little bit of Adobe stock. I feel like I should just tell you that. I like to own a little bit of stock before trying to understand a business, because there's something different about when you're an owner. It changes how you look at it. And then finally, this analysis was mostly performed in March and April of 2026, when the price was between $240 and $220. And not only might that price have changed when you're watching this, but the business itself might have changed as well. So you have to keep that in mind and take this for what it is, which is a moment in time understanding. So without further ado, let's get into the business model. Okay, first things first. They traditionally had 3 segments of the business that they reported, which were digital media revenue, digital experience revenue, and then publishing and advertising revenue. This has actually changed in FY26, but we'll talk about that a lot later. The main thing you need to know, which you can see in this chart, is really just how much of the business comes from digital media revenue, which is mostly made up of their Creative Cloud, which is what you think of Adobe as being, which is like Photoshop, Illustrator, Premiere Pro, their entire app bundle. The digital experience revenue, I think, is a little bit more interesting, and I think is really important for understanding where Adobe might be going forward. And that is really another bundle of apps and software which helps marketing professionals manage marketing campaigns. And the customers here are basically marketers, advertisers, brand managers, etc. We'll look at this in just a little bit, but this is really like a end-to-end marketing management solution. And then the publishing and advertising business is basically legacy products, and they're not really even worth thinking about or analyzing, I would say, because it's a dying business. So we can see here that basically the digital media revenue is about 74% of the business. The digital experience is about 25%, and then the publishing and advertising about 1%. And that's why I'm saying that I don't think we even need to really pay attention to it. And then just note here and try to keep in mind the change we saw from FY24 to FY25. So the fastest growing segment was still the Creative Cloud business at 11%. And then the digital experience, it grew 9%, which, I mean, high single-digit growth for most businesses is pretty good. Generally, I think Adobe would like to get this into low double-digit growth, so between, I don't know, 10 and 14%. I mean, I'm sure they would love to get it higher than that, but realistically, I think they would want this to be higher than the digital media growth, because as we'll look at in this video and in further videos, this is sort of a better and safer business that I think they will really want to focus on in the future. And then again, the publishing and advertising is a dying business. So what I like to do is, rather than just reading a description of what it is, actually see with my eyes what these products are. So if we look at the digital media business, this is from one of their investor slides from 2024. So this includes their Firefly models, Creative Cloud apps, Adobe Express, Firefly services. This is basically generating brand content with AI, and then you can, put it on a product or whatever, and then maybe you're sending that to your manufacturer, and it has all the measurements and stuff, and then they can wrap their water bottle in your branding. And then Acrobat and AI Assistant is also part of the digital media. Okay, so digital experience. I think this is kind of helpful to help you get your head around all the things that digital experience means for Adobe. Again, this is a bit of an outdated slide now, but I think it helps break down where they were just like a year ago, basically. So main thing would be the applications here. So Adobe Analytics, this is data collection and data management, customer journey analytics, Adobe Commerce, Experience Manager, Adobe Campaign, that's the campaign management software. But really what you need to know is that this is an end-to-end marketing software solution. And as AI becomes more and more important and a threat to Adobe as a business, they seem to really be leaning into this as what they want their core product offering to be, because I think they see it as being a more defensible business. It becomes where the customer data lives, all the workflows and automations that a campaign requires, as well as a lot of the implementation costs that enterprise software requires when it's getting onboarded onto a business, and how that becomes so sticky and hard to break away from once it's in a business. And then again, I literally haven't done any research on the publishing and advertising revenue because I don't think it's worth it. Okay, and then the other way to look at the business that they report is whether or not that revenue is coming as a subscription, as a product, or as a service. And really what's important here is that 96% of their current business and growing is from subscription or SaaS revenue. Everything else is basically being killed off because SaaS and software is just such a honeypot of a business model. And then one other thing that I want to call out here is that this has really been the bread and butter of their business model since 2010 under the current CEO, who transitioned the business from a one-time purchase of software to the SaaS business model. That was really the last major shift in the business when it was forced to move by the evolving market, which was the shift towards cloud. So that's to say that it has undergone a major transformation in business model before, but it has been, 15, 16 or more years since that transition took place. So the subscription model is really embedded in the heart of the business and what it is today. Okay, and then moving on from here, we're gonna look at the customer segments. This is again gonna be super important to understand in later episodes of this deep dive when we go and we look at what the threats are, what the moat is, and how they defend their territory as the leading creative software. So number one is individuals and students. These are, hobbyists, freelance creators, someone you might hire on Fiverr or Upwork, and then students. And by students, I don't mean, the business undergrad that uses Adobe to make like a brand for a presentation. I mean creative students, because, and I'm not speaking from data here, but I suspect that those other business students that need Adobe like for one time have already moved to apps like Canva or Affinity because they're free and students don't want to pay for it. Hobbyists, I think, are the exact same. I think most of them have already moved to Canva or some other open source app that they don't have to pay for because these customers generally have pretty high price sensitivity. And then freelance artists, I think, have high price sensitivity, and there is high competition in terms of like Affinity or Procreate or DaVinci Resolve for video editing, which are all free apps. Probably most of them have switched there, but I think there probably is a little bit remaining that are just sort of stuck on Adobe and don't mind paying the monthly fee. So the students that are still there, these are again the ones that are in school for creative work. They have medium price sensitivity because one, Adobe has a student discount, and then two, a lot of the times universities will actually give the software to the students at some like very steep preferential rate. So that's actually really important, and we'll come back to that as we go through this analysis. But those creative students learning on Adobe is really a key funnel for Adobe as a business. Okay, the second cohort of customers are small and medium businesses. So these are things like creative service agencies, marketing agencies, design studios, video production houses, photography studios, architectural visualization firms. These, in my understanding and my thinking, have a lot lower price sensitivity. Really, they care about getting the job done and delivering to their customer. That's their core business. They don't care as much if they have to pay whatever amount every month, as long as it helps them on their deliverables, maintaining their reputation as someone who is good to work with, and helping them get more business in the future. Here the competition is medium because I think it really depends on the agency, on the industry that they work in. Like, it's just so segregated. The second subgroup of this cohort is document-heavy businesses. So that would be like professional services, maybe like an accounting firm, legal, HR, something like that. Again, medium price sensitivity. But here, I think the competition is a lot higher because we're talking about Adobe Acrobat, which I don't know, I might be wrong about this, but I feel like that's like a legacy software. And there is, alternatives like DocuSign for like doing your signatures. Microsoft is obviously a player here. And the thing with Microsoft is that they bundle their software. So they basically give it for free to businesses that are already on Excel and Teams and Microsoft 365, as well as obviously, which I should have put here, but AI services. So if you can upload your PDFs to like Claude or Gemini and then ask it questions and whatnot, that is obviously a competition for opening your PDF in Adobe Acrobat. And then finally, I've put marketing and e-commerce small businesses if they're doing like branding or a t-shirt markup or something like that. Again, I think that this is a medium price sensitivity. It might actually be closer to high, to be totally honest. And then here the competition is also high. So they don't have like super demanding needs from their software, and probably Canva, which has been around for a while. And then AI now is probably a viable solution for them. These two customer groups, individuals and small businesses, some of the small businesses, these can really be described, I've seen, as like good enough businesses where they just don't need all the power and ecosystem of Adobe, and the competition like Canva and Figma, etc., are generally going to be good enough for their needs. So anyway, finally, we're going to look at enterprise, because I think this is one of the more important sides of the business to talk about. So we need to understand it. Number one would be enterprise creative teams. So this would be like your marketing team in your Fortune 500 business. Like one of the brands under Procter & Gamble, I think Old Spice, I might be wrong about that, but they probably have an in-house marketing team, and they use Adobe to create the branding and the packaging, art, as well as, I don't know if Old Spice still do TV commercials, but if they do, they would probably do those as well, or play a role in those commercials. So they use Creative Cloud and the workflow-based digital experience product suite. Enterprises, obviously they have low price sensitivity. Again, they want solutions, and price obviously matters. They are more or less willing to pay a premium for the right solution. There is some competition here, and there might be in the future, for example, if Microsoft wants to get more and more into this area, but for the most part, it's not as high as the good enough category, which can use Canva. These two are really linked in terms of who's sort of like using their software, but more on the Experience Cloud side, this is like where the data infrastructure lives. This is like a version of Salesforce or Oracle for marketing data. And one of the things that's really important here to understand is the complexity of setting this up. Like, there are consulting firms like Deloitte or Accenture which have full teams across the world to help organizations implement software solutions like Experience Cloud. Deloitte has more than 2,000 full-time employees just dedicated to Adobe Experience Cloud. That's how entrenched of an industry it is. And I think that's important to recognize as we go deeper into Adobe and who they are. This is like established stuff. And it could cost millions of dollars and months of work to get Experience Cloud onboarded into a company. And once you do, switching costs are really expensive, and you would have to do it again essentially for another company. So it's often just not worth it. And that's what makes enterprise software so sticky and so valuable as a business model. And then I think we've talked enough about Document Cloud. So let's just move over here. And what I want to start to understand now that we've looked at the customers and the products are the unit economics and the flywheel that Adobe has going for it, and why it's been able to last so long as a software solution in the creative industry. So first things first, this is the pricing and cost structure. So Adobe is obviously the industry standard and is kind of the creator of creative software. Like Photoshop is the verb to edit an image. And they have a bit of an advantage here that we've seen because they've raised prices multiple times in the past and it hasn't really affected the business. That is what the power of being an industry standard solution is. You're able to raise prices if you need to in order to sustain growth or to maintain your margins against rising costs. It has historically had a monopoly in the education stage of user acquisition. Students learn on Adobe software. I think most people watching this are like finance students or finance professionals. This is like us learning on Excel how to build financial statements or a financial model. I'll say this now, and I'm sure I'll say it again in a future episode. I'll never switch to Google Sheets. If an employer wants me to work on Google Sheets, I don't want to work for them. Excel is where I live. It's how I do my work, and I can't do it any other way. So that's really important when we understand the Adobe flywheel, because the students learn on Adobe, they enter the workforce expecting their employers to use Adobe, they build projects in the Adobe file ecosystem, which means that they're sharing it between businesses as a Photoshop file or as an Illustrator file or whatnot, and they create templates and workflows that are used year to year, month to month, campaign to campaign, which enforces the file formats and workflows as an expectation to be used in the industry, which means that students have to learn Adobe. And the cycle repeats and repeats. And that gives Adobe incredible strength and staying power as a business. On the cost structure, again, we're going to look at this in way more depth in the next episode when we go to the financial statements and we look at the fundamentals of the business. But most cloud businesses have a pretty favorable and minimal operating costs. Most of their costs are like cloud services, which are pretty cheap, and then their sales and management salaries, as well as maybe some R&D expense for creating new software. And then finally, just to understand the enterprise business model a little bit more, these are traditionally multi-year deals. They're negotiated through multiple departments in the business. And then we sort of have like consulting groups that help negotiate them as well and then implement them. So those customer acquisition costs are super high. And then in order to sell to enterprises, Adobe does obviously have to employ a full-time sales team, which they don't necessarily need for pure creative professionals because of that student flywheel. But those costs are sort of one time, and once the customer is on the system, it doesn't cost very much to retain them because those switching costs are so high. So that is like the high level overview of the business. What I want to do now, just really quickly before we move on, is just raise this flag, because for me, I would call it like an orange flag, and you come across it pretty quickly when you start to analyze Adobe, and that is that they've changed how they report the business several times in the last like couple of years. I used Claude to put together this timeline, But basically in 2024, they stopped reporting what they call Creative Cloud revenue and Document Cloud revenue, and then the apparent ARR around those as well. This is really helpful because this is very much like one segment of the business, different use cases, different customers, and helps analysts understand what is actually happening to the different parts of the business. And they just stopped reporting that. Then in January 2025, they stopped reporting net new ARR and just now report ending ARR growth at the end of the year. This is again an act that obscures what is happening a little bit and makes it harder for us to understand what is happening on a quarter-to-quarter basis. And then again in FY25, they introduced two new groupings of reporting. So this is what they call creative and marketing professionals, and then business professionals and consumers. Now, this is where it gets super weird because creative and marketing professionals is Creative Cloud, which again is students, individuals, small and medium businesses, and marketing teams using Creative Cloud at an enterprise level, and all of Experience Cloud. So like, there's no way to separate these anymore. It's really, really tough to understand what is happening at the individual level, what is happening at the small and medium business level, what is happening at the enterprise level. They're, again, obscuring information from the analyst. In my opinion, I think they would probably say that this is how they view the business, so it's more clear, but for me, I don't like it. And then the business professionals and consumers is just Acrobat and Express. It's a weird grouping again. They say in some of their investment earning calls that they see creativity and productivity merging and becoming one thing with AI, and that's why they're doing this. But really, like, this is like a very consumer-facing creative app. And then, this is like PDFs. So for me, this is like not related whatsoever, and I think it's super weird to group them as well. And then finally, basically, they stopped reporting their digital media and digital experience, and now they only do these customer groups of creative marketing professionals and business professionals, which is really frustrating. So that's FY26 going forward. We're going to specifically try to use FY25 values as our baseline, and then we'll try to work in 2026 when we need to. So really, we're going to be sticking to these segments down here, which is the digital media revenue, digital experience, and then the publishing and advertising, because I think that those are most illustrative for the business and understanding where it is and where it might be going. And here you can just sort of see the side-by-side difference of what the revenue looks like under the two frameworks. Okay, so I just wanted to give you an update on that and help you understand where I'm coming from when we move to the next part of part one, which is revenue predictability and return on invested capital. These are two metrics that I think are really important for understanding a business at a high level, and that's why I've included them in this section. Number one, we're going to look at revenue predictability. So what you're looking at here is the Adobe annual recurring revenue and its growth rates, which is this purple line here. Annual recurring revenue is not GAAP, but it is really useful and is really the software industry gold standard of measurement, because ARR gives you a little bit more of an idea of where the company is going to be in a year or so. So you can think about ARR as if they have 1,000 customers and each is paying $10 a month, they have 10,000 ARR. That's all it is. So we can see here, we only have 3 years of data, but it looks pretty good. It grew year over year from 12% growth to 13.5% growth, which is pretty big for a company as big as Adobe, to grow from 22 billion ARR to 25 billion in 1 year. You're growing by 3 billion in revenue. One caveat that I think is important is that if we switch to the quarterly view and we look at Q1 of 2026, that 13.5 dropped a lot in Q1 down to 10.9. So it's decelerating for what is considered to be a growth company and whose valuation is based on its ability to grow ARR. This momentum is really one of the reasons why the stock is dropping. And obviously they were asked this in their earnings call, and what they've said is that this is really driven by AI. Their traditional stock image business is being eaten quicker than they expected by AI. And that is concerning, not because the stock business is like the bread and butter of Adobe and that Adobe's going away because of AI, but I think it illustrates how quickly part of a business can be destroyed when a competitive solution arrives in the marketplace. And then I'll also just say that this is from their most recent investor deck, and you'll see here, this is their sort of like consumer-facing segment of Adobe and Express, and the management has also said that that ARR growth is partly purposeful because they're essentially trying to grow this part of the business, and then later they will be converting it into like paying customers. A lot of this is free or freemium, where you can buy sort of credits to use, and then they're hoping that that will later convert into, you know, their more profitable lines of business. So, you know, take that for what you will. That's their explanation. And then the second thing I want to look at for revenue predictability is remaining performance obligations. So this is legally binding contracted revenue that hasn't been earned yet. So, you know, they sign a 3-year contract for $3 million, but only 1 year has passed, which is the part that they've earned. So $2 million is still sitting in remaining performance obligations. So we can see here, obviously, that this is growing and growing pretty strong on a year-over-year basis, I would say. That essentially means that the company is booking deals faster than it can fulfill them. That is obviously exactly what you want in a business. And then this line here, this orange one, this is the RPO to be recognized in the next 12 months. So from that example before, 1 million of that remaining 2 million on that 3 million contract is sitting right here. This is a good thing if it's going down, so to speak. I mean, it can go both ways, but more or less what it means when it's going down is that customers are booking long-term deals. So revenue recognition will be sort of like delayed, but really it shows confidence that their customers think that they will need Adobe services for a long time. And that's exactly what we see, right? This is going from 72% in December 2022 to 65% in November 2025. That's a great sign. So I would say this looks pretty good, with the caveat that on a quarter-to-quarter basis, the ARR is actually dropping, and we sort of know that it's due to AI, whether or not that's just like a product that's better or that they need to sort of change their business model because of AI. So that is kind of alarming. That's not really what you want to see when you look at a business like this. Some other things that you might want to think about when you're looking at a business is like the customer level risk, and Adobe doesn't have a single customer level risk whatsoever. Their small and medium businesses are so diverse, individuals so diverse, enterprises super diverse, tons of different customers. But I would say that they do have a concentration risk in their Creative Cloud business. I mean, this represents, you know, whatever we saw, 70% of their business overall. If this gets disrupted by AI like this, like they are definitely in trouble. So we're gonna definitely try to understand that in later videos of this series. Okay, and then finally, we're gonna look at return on invested capital. This is so important. This is really how efficiently the company converts invested money into profit, which they can obviously reinvest or distribute to their shareholders. It can vary pretty significantly depending on how you want to calculate it. I'm using the number from Fiscal AI, which, you know, if you really care, you can pause the video and like look into this. This is how it's being calculated. And the one thing that I would just call out is that Adobe has a large deferred tax asset and a lot of deferred tax revenue. So that will sit in invested capital as the denominator, but is not actually capital that is invested in the business. So the denominator is sort of inflated, I think, when they're doing this sort of calculation. And if the denominator is inflated, then the return on invested capital is deflated by using this metric. And this is from the balance sheet, but you can see their deferred income taxes right here. And that is almost $2 billion. And then also from the liabilities side, you can see their deferred revenue right here, which is $7 billion. So, that has like a pretty material impact on the calculation, depending on how you're going to use it. It wouldn't be useful to use this calculation to compare Adobe to a non-SaaS business, like, I don't know, ExxonMobil or something like that. It's just not going to be comparable. But it's definitely fine to use it to compare Adobe year over year. And most SaaS peers have similar balance sheet structure, so it's more or less fine to compare across peer groups as well. But if you were doing a really detailed deep dive between them, you'd probably want to try to adjust that out. Okay, so looking at this, again, more or less on a year over year basis, like amazing numbers, I would say. Like we're going from almost 18% in 2016 to what is it? I just covered it up, but 36% in 2025. This is like best in class software. Here's a comparison across maybe some of their peers. So blue is Adobe, orange is Intuit, purple is Workday, green is Salesforce, and then red is Oracle. I mean, you can just see that basically from 2021, it started to catch up on Intuit. Intuit has dropped down a lot. And then basically since 2022, Adobe has just really been in a class of their own in terms of their return on invested capital. So what that sort of means is that their capital allocation has been really, really good. And generally you want to compare that to their weighted average cost of capital, which is probably between 9 and call it 12%. And as long as it's higher, which at 36% it obviously is, that means Adobe is compounding. Okay, so we have covered a lot here in this first video. So what I want to do is just go through and try to summarize our new understanding of what Adobe is as a business before we get into the nitty and gritty in the next video. So what do we know? Adobe is a subscription business with high revenue predictability. ARR growth, which is the most important metric for future earnings, is growing annually, but not quarterly. The sample size is small, but if this quarterly trend continues, it is definitely worrying for the business. Remaining performance obligations are very positive. RPO is growing, and then next 12-month RPO is shrinking. So that's pretty important, I think, in a world of AI, that the customers think that they are still going to need Adobe, at least the ones that are still making deals with them. Return on invested capital is largely in a class of its own and improving by the looks of it. And then the only sort of like caveat, I guess I would say, is that what we're comparing it to are enterprise businesses. Well, Adobe has small and medium business customers and hobbyist users who are more likely to leave to Canva or good enough tools, but that's also almost like more complementary, I think, to Adobe rather than like a caveat, because enterprise business is kind of better business than consumer business or small, medium business. And to be honest with you, I feel like this also isn't much of a risk because, as I've said before, I think that most of the customers who have a low bar of quality will have already left years ago for tools like Canva. So I think that really what we're dealing with is more of the stickier consumer base already when we understand the business as it is today. Okay, so that is the business model. In the next video, we're gonna do a deep dive on the fundamentals. We're gonna look at the income statement, the cash flow statement, the balance sheet, and we're gonna look at some of the valuation metrics that are most important compared to other software and enterprise software businesses. So if you're interested in that, subscribe. Like I said, we're doing a crazy deep dive here to really just understand it because it's fun and hopefully you enjoy watching it. So if this video was useful, give it a like, subscribe, share it, all that cool stuff, and I will see you next time.